The dollar's greatest danger is not China's ambition. It is America's debt. That is the part most people do not want to say clearly. The Yuan is rising. CIPS is expanding. BRICS is signaling more trade outside the dollar. And oil exporters are experimenting with new currencies. Those are all important. But they are not the center of the story. The center is this. America built a government, a military, a consumer economy, and a financial market on the assumption that the world would always need to buy dollars. China is now challenging that assumption. That is why this moment matters. When people hear that nearly 30% of China's foreign trade is being settled in yuan, they usually ask the wrong question. They ask whether the yuan is ready to replace the dollar tomorrow. It is not. The yuan still has capital controls. China's financial markets are not as open as America, as the U.S. Treasury market is still deeper than anything China offers. All true, but also incomplete. The real question is not whether the yuan can replace the dollar tomorrow. The real question is how much dollar demand America can afford to lose, because the United States is no longer the creditor empire it was. After World War II, it is a debtor empire. It depends on the world's willingness to hold its paper, finance its deficits, buy its bonds, and treat its currency as the safest parking place on earth. That willingness is still there, but it is no longer automatic. That difference is enormous. For decades, the American model worked because it had three pillars. First, global trade needed dollars. Second, oil needed dollars. Third, foreign surplus. Dollars came back into U.S. treasuries. This created a machine that almost looked magical. America could import more than it exported, spend more than it collected, borrow more than ordinary math would allow, and still enjoy lower rates than almost anyone else. Why? Because the rest of the world needed the operating system America controlled. If you needed oil, you needed dollars. If you needed banks connected to the American-centered system, if you accumulated dollars, you needed somewhere safe to put them. So you bought treasuries. That is the hidden engine behind American power. Not just aircraft carriers, not just Silicon Valley, not just Wall Street. The real engine was forced demand for dollars. China's financial strategy is designed to turn forced demand into optional demand. That is a much bigger change than it sounds. If the dollar is optional, America has to compete for capital like everyone else. If America has to compete, lenders ask harder questions. How much debt do you have? How divided is your politics? How large are your deficits? Can your central bank control inflation? Can your government restrain spending? Can your economy still produce enough real goods to justify its claims? Those questions are painful because America has avoided them for a long time. Reserve currency privilege gave Washington room to delay discipline. China is trying to shrink that room. This is why CIPS matters. It is not merely a Chinese version of SWIFT. It is a strategic bypass around the most powerful financial pressure tool the United States possesses. When America can cut a country off from global settlement, it can punish without firing missiles. It can freeze a state in place. It can make banks refuse transactions before soldiers move. But every time Washington uses that tool, it teaches others a lesson. Do not keep all your doors inside a building controlled by someone else. Russia learned that lesson after sanctions. Iran learned it over years. China learned it before it needed to. The global South watched and understood that today's sanctioned country may not be tomorrow's only target. The result is not ideological unity. It is defensive engineering. Countries are building payment routes that do not require American approval. That is what makes the yuan's rise dangerous to the dollar system. Not because everyone trusts China more than America, because many countries trust dependence less than they used to. The petrodollar shift is the clearest example. Oil is not just another commodity. It is the blood flow of industrial civilization. If oil is priced and settled in dollars, the dollar remains necessary to everyone if even a meaningful portion of oil begins moving through non-dollar settlement. The world's need for dollars becomes less absolute. Saudi Arabia does not have to announce the end of the dollar. It only has to accept more yuan from its largest customer. The UAE does not have to turn anti-American. It only has to keep more doors open. India does not have to join a Chinese bloc. It only has to prefer cheaper, more flexible settlement in certain trades. Brazil does not have to abandon the West. It only has to decide that trading with China directly in local currencies saves costs and reduces risk. That is how systems change, not through betrayal, through convenience, through hedging, through fatigue, through the quiet conclusion that one country should not be able to choke the financial life out of another country overnight. Now connect that to American debt. Foreign ownership of U.S. treasuries has fallen sharply from the levels seen around the 2008 crisis. That does not mean foreigners are dumping everything tomorrow. But it does mean the old recycling machine is weaker, fewer trade dollars automatically returning to treasury auctions, means America has to rely more on domestic buyers, banks, pension funds, and the Federal Reserve's credibility that raises the cost of mistakes. When America had overwhelming dollar demand, bad fiscal policy could be absorbed longer. When demand weakens, every deficit matters more. Every debt ceiling fight matters more. Every inflation surprise matters more. Every war, bailout, stimulus package, and unfunded promise becomes harder to finance without consequence. This is where ordinary Americans enter the story. The decline of dollar dominance does not arrive first as a headline saying the empire is over. It arrives as stubborn interest rates. It arrives as mortgage payments that feel permanently too high. It arrives as a government paying enormous interest on its own debt. It arrives as inflation that does not return neatly to the old world. It arrives as retirement. Accounts swinging harder because bond markets no longer behave like a guaranteed shelter. It arrives as a grocery bill that keeps absorbing the cost of a weaker financial privilege. People will be told many explanations. Supply chains, corporate greed, wars, energy shocks, central bank policy. All of those may matter, but underneath them sits a deeper question. Does the world still need dollars as much as it once did? China's answer is no, not no. Today, not no completely, but no more than necessary. That is the strategy. CIPS creates the payment rail. The digital Yuan creates the settlement layer. Bilateral trade agreements create usage. Yuan-denominated lending creates future demand. Commodity purchases create liquidity. BRICS and regional institutions create political cover. Each part reinforces the others. A country that borrows in Yuan needs Yuan revenue. A country that sells commodities to China can receive Yuan. A country that receives Yuan needs a place to store, spend, or invest it. A bank that sees more Yuan flow joins the network. A network with more banks becomes more useful. A useful network creates more flow. This is not a slogan. It is a flywheel. Washington keeps acting as though the dollar as past guarantees its future. Beijing is acting as though the future belongs to whoever builds the rails before the crisis arrives. That difference in behavior is the most important part of the story. America still has advantages. China does not. It has deep capital markets. It has legal traditions investors understand. It has military reach. It has alliances. It has technology. It has the world's most liquid bond market. Nobody serious should pretend those disappear overnight. But advantages can be wasted. A country can have the strongest currency and still weaken it through overuse of sanctions, endless deficits, political chaos, and a refusal to understand why other nations want alternatives. That is what America risks. Now, it is treating de-dollarization like a political insult. China is treating it like an engineering problem. Engineering beats outrage. The most dangerous sentence in American finance is, there is no alternative. For a long time, that sentence was mostly true. There was no full alternative. No currency had the scale, liquidity, trust, and network effect to displace the dollar. But history does not require one complete alternative to appear instantly. It only requires partial alternatives to become good enough in enough places, good enough for China, Russia trade, good enough for China, Brazil settlement, good enough for oil between Beijing and Riyadh, good enough for loans to developing nations, good enough for sanctioned countries, good enough for governments that want insurance. When enough good alternatives exist, the monopoly is gone, even if the leader remains on top. That is the moment we are entering. The dollar can remain number one while losing the privilege of being unavoidable. That is still a historic loss. The pound remained important for a long time after Britain's peak. London did not vanish. British banks did not disappear. But the center of financial gravity moved. The empire could not finance itself the old way forever. Debt, war, industrial decline, and new competition changed the balance. Ray Dalio has described this pattern as part of a long cycle. Great powers rise when they produce, save, educate, innovate, and trade competitively. They dominate when their currency becomes the reserve asset. Then they borrow against that dominance. Over time, debt rises, internal conflict grows, manufacturing weakens, and competitors build alternatives. The decline is not one event, it is a sequence. The United States is now inside that sequence. The Yuan does not have to be perfect for the sequence to continue. It only has to grow where the dollar is most resented, most feared, or most expensive. The shocking part is not that China is trying this. Every rising power tries to reduce dependence on the dominant power. The shocking part is that America is helping it by making the dollar system feel less neutral. When the dollar is seen as a shared utility, countries tolerate dependence. When the dollar is seen as a weapon, countries pay to escape. That is the strategic mistake. The United States wanted sanctions to enforce obedience. It may have taught the world to build exits. It wanted treasury markets to remain the unquestioned center. It may have encouraged central banks to diversify. It wanted allies to follow its financial rules. It may have pushed even friendly countries to quietly connect to Chinese infrastructure, just in case. This does not mean China wins automatically. China has problems too: debt problems, demographic problems, trust problems, capital control problems, political opacity problems. Many countries using the yuan still do not want to live under Chinese dominance. They are not choosing Beijing as a new master. They are choosing leverage against the old one. Distinction matters. The future may not be a yuan empire replacing a dollar empire. It may be a fractured world where countries hold dollars, yuan, gold, local currencies, and digital settlement tools side by side, because nobody wants to be trapped inside one system again. For America, that is still a major downgrade. An empire built on monopoly power does not need to lose everything to lose its special privilege. It only needs the world to diversify. That is why the real number to watch is not just the yuan's share of reserves. It is how much trade no longer needs dollars. It is how many banks join alternative rails. It is how many oil contracts are settled outside the old system. It is how many developing countries borrow in yuan. It is how many American allies quietly build backup access to Chinese financial infrastructure. Those are the signals, and they are flashing the dollar as replacement has not arrived as a single new king. It is arriving as a map of escape routes. That map is being drawn. Now, one payment rail at a time, one trade deal at a time, one oil shipment at a time, one treasury auction at a time. By the time the public understands the map, the largest players will already be using it. That is how financial power shifts, slowly enough to deny, then quickly enough to shock,